Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 804A, and today's date is October 29th, 2015, and the title of this episode is China Puts Pressure on the Dollar, Sets Up Yuan-Denominated Exchange in Germany. Let's get right into the economic collapse financial news. Well, it looks like the high-frequency traders, the plunge protection team, had a tough day today. They couldn't get the market above the negative area, and we're seeing a lot of economic indicators coming out, and they're all pointing in one way. And we're hearing a lot from corporate media, we're hearing a lot from financial pundits, and they're all starting to say, yeah, this is starting to look like a recession, but as we know, this is already a depression collapse scenario here. I mean, this is spreading throughout Europe, and it's getting worse. I remember going back a year ago when people would laugh at all the economic indicators showing that we are headed in this direction. And here we are today, and it is getting worse. It's not getting any better. And a lot of countries are starting to feel it. I mean, right now in the UK, the London property market is increasingly being recognized as a gigantic bubble. And now international banks are warning that the bubble is ready to burst. According to UBS, England's capital is home to the most significantly overvalued housing market of any major city in the world. And they're worried that the bubble is ready to explode there. Now, it's not just in the UK. It's all throughout Europe. It's in Canada. It's here in the United States. It's in Australia. And we're all starting to see the same signs. And it looks very similar to 2007 going into 2008. Here in the United States, they're continually pushing the illusion that everything is fine. They're telling us that the initial jobless claims, they're very, very low. They only rose 1,000 from 259,000 to 260,000, which beat expectations of 265,000 people. And this is the lowest since 1973. Now, there's a huge problem with this. There's a huge divergence between claims and the real job cuts, the layoffs. And if we go back to June 2014, up until this point, we are approaching 1 million layoffs. And yes, we added part-time work. But let me just say, those people who are losing their jobs, they're not going to claim anything? Of course they are. So again, someone is lying. We're seeing job cuts trend up and initial claims trend down. They're going in opposite directions. Now, of course, remember, the job cuts are not coming from the government. They got rid of that department in 2013. Yes, the BLS kind of looks at it, but they kind of discard it to the side. This information is coming from a private company, Challenger Gray and Christmas. And this shows us that the U.S. government doesn't want anyone to know that we have a major problem. And that problem is more and more companies are laying off. The economy is contracting. Deutsche Bank is reporting 35,000 people are going to be laid off. They're going to exit in 10 different countries. Bank of America just announced another 100 people in Charlotte. Baxter, 1,400 people. Cummins, up to 2,000. National Journal, 25% of their staff. The layoffs are continuing. And when we hit 2016, it's going to explode like you've never seen before. Because you know this holiday season is not going to be a good holiday season. You know that retail has been contracting. The American people aren't spending. We know the factories aren't producing. We know inventory is bloated. They're not going to be able to move the merchandise. The shipping is slowing down and trucking is slowing down. Gee, you don't have to be a rocket scientist to figure all this out. We're headed towards a major collapse, and a lot of the information that we're looking at right now is 10 times worse than 2007, 2008, 2009. Now, we understand in the housing market, where they're continually telling us we're in a recovery, no, we are in a bubble because it was created by the central bank. Now, we saw new home sales crash in September. We are seeing mortgage applications continually slide. We're seeing home builder sentiment increasing, going up. Of course, they're just hoping that everything just fixes itself. And now we see pending home sales in September plunged by 2.3%, missing their expectation of 1% rise. This is the biggest month-on-month drop since December of 2013. But don't worry, we have the National Association Realtor, my friend Larry Yuan. And he's out there, and he always had some type of comment to say on what the housing market is doing, and it is always the opposite of whatever he's saying. Today, he's saying that signs of a slowing U.S. economy may be causing some prospective buyers to take a wait-and-see approach. Well, I'm going to say most of the potential or prospective buyers are sitting on the sidelines going, I have no money, I have no job, or I have a part-time job, and you know what? I just lost my house. I'm not buying another one. We have to remember, Larry Yuan from the National Association of Realtors, all throughout 2008, during the crisis, was telling us that housing was going to pick up during the winter months of 2008 going into the spring. And what happened? It was the actual opposite. It got really, really bad, and things started to accelerate in a downward, steep trend. And a lot of people couldn't hang on to their homes. They foreclosed. There were a lot of short sales. People lost their wealth. It was a complete disaster. So whatever they're out there saying, it's always the opposite. This real estate market right now is crashing. It's falling apart. Think about this for a second. Mortgage applications continually declining. Back in 2013, moving forward, Bank of America, JP Morgan Chase, Citibank, Wells Fargo, all laid off tens of thousands of people. They're continually laying off people in the mortgage department. Now, if the housing market is doing incredibly well, why would you get rid of all the people that are working on mortgages? Because you would see mortgages increase dramatically, but we're not. We're seeing them in a downward trend. Why? Because most of the purchases are coming from cash. Where are they getting this cash? From the Fed. Hedge funds, investment companies getting the free money, foreign investors looking for places to park their cash. A lot of them don't want to go into the stock market, so they're taking their cash and they're putting it into homes. A lot of these investment companies and hedge funds are buying not just one home, not two, thousands of them, and they're sitting on them. The Fed instructed the banks, do not foreclose on homes. Let people stay in them. This will make prices rise. There's always a strategy, and now we see the whole thing falling apart because the American people are sitting on the sidelines. So what do? They create a mortgage program which allows you to come in with 3% down. Some banks 0% down. They don't even check credit. They'll just give you a home. But again, the American people, they're not out there. The whole thing is a scam. It's a Ponzi scam. Now, we know the second quarter GDP, they pumped that up to 3.9%. They took everything from the third quarter, pumped it into the second quarter, make it look really, really good. And now we get the information that the third quarter GDP is at 1.49%. Well, why is this? Why all of a sudden did it completely fall apart? Well, we have to remember the entire country is not manufacturing. People aren't spending. Remember, a lot of the GDP is made up of consumer spending, manufacturing. So what kept it above the negative range? That's a big question. Well, of course, it was Obamacare. Obamacare for the last couple of quarters, which is now included in GDP, which is very strange because taxes, penalties are now included in the calculation of GDP. So Obamacare was included, and it was the biggest contributor to the GDP numbers. It gave it a $60.6 billion annualized increase. And where did this come from? This came from the penalties and taxes included in Obamacare. What we should do is just add all the taxes and penalties from everything, and we can bring GDP up to what? 9%. But this isn't helping the economy. There's no production. There's nothing of value from Obamacare. This is being used to keep this economy in this ridiculous illusion. That's all they're doing. Now, Goldman Sachs is out there, and we know we cannot trust them whatsoever. But they're telling us that buybacks, the companies, the corporations that are buying back their stock, it's no longer working to boost the stock market. Well, it looks like this has run its course. But they said something else which is very interesting, and this is when you should really start to worry. Whenever a banker or the central bank or the government uses this term, you know it's time to panic. Goldman says the U.S. manufacturing decline is now contained. How can it be contained? The Baltic Dry Index, which is the raw material of goods, continually sliding. Manufacturing is continually declining. People are not going out purchasing any of these goods. And Goldman is telling us that it's contained. We have 1.4 million manufacturing jobs that were lost and replaced by 1.5 million part-time jobs. So basically what they're saying, just like the central bank back in 2008 when they said the subprime was contained, we're heading for a huge disaster. Basically, the 6-year grand illusion is now ending. For 6 years, the world has operated under a complete illusion that the central bank somehow fixed the 2008 crisis. And why I say 6 years is I'm calculating it really from 2009. Now, a fifth grader would tell you that you cannot solve a debt problem by issuing more debt. It's completely impossible. It doesn't work. And we have Greece to show that, yeah, it doesn't work. Cyprus to show, yeah, it doesn't work. And the rest of the countries in the European Union showing that whatever they were doing by adding more debt to these countries, it just made it worse. So we also see that from 2008 moving forward, we added another 10 trillion in the debt to the U.S. system. So this is not helping either. So here are some of the facts. The real problem for the financial system is the bond bubble. In 2008, when the crisis hit, it was 80 trillion. Now, it's 100 trillion, 20 trillion more. The derivatives market that uses this bond bubble as collateral is over 555 trillion in size. Many of the large multinational corporations, sovereign governments, and municipalities have used derivatives to fake earnings and to hide debt. No one knows to what degree this has been the case, but given that 20% of corporate CFOs have admitted to faking earnings in the past, it is likely it is a huge amount. Corporations today are more leveraged than they were in 2007. The central banks now are leveraged at levels greater than or equal to where Lehman was. The Fed right now is leveraged at 78 to 1. The ECB is 26 to 1. When Lehman imploded, it was 30 to 1. The central banks don't know how to exit from this strategy, this plan they created. They don't know how to get out of it. Their balance sheet was $1.3 trillion in 2009. It is over $4.5 trillion. We have a major problem in this country. We are headed in a direction which is a full collapse of the system. And everything that we look at, we know the banks are completely insolvent. We know we've been holding steady at 0% interest rates. I mean, what are they going to do? Put it to negative? This is not going to help. They've been manipulating the unemployment numbers. They've been manipulating the GDP numbers. They've been manipulating the inflation numbers. They're telling you that everything is fine. And now we hear little voices out there saying, oh, we could be heading into some type of recession. It looks like if we keep going in this direction, it might be a slight recession, which means that we're headed into a complete disaster. And now Goldman, of course, came out and said they have manufacturing contained. This is a huge, huge problem. Now, the U.S. government, as we know, is passing a new budget. And hidden in the U.S. budget is something that everyone is not going to like. And what the government is going to do is they're going to use robocall debtors to find those people who owe student loans, taxes, and mortgages. So the government right now, as part of the 2-year budget bill, Section 301, would amend Section 227B of the 1935 Communications Act, which prohibits automated calls to any phone service for which the recipient is charged by adding the qualifier unless such call is made solely to collect a debt owed to or guaranteed by the United States. The bill gives the Federal Communications Commission 9 months to prescribe regulations to implement the amendment made by this section. So what they're going to do is you're going to be receiving on your cell phone, if you owe taxes, if you owe student loan, if you owe mortgage taxes or mortgages or anything like that, most likely falling under Freddie and Fannie, they will be giving you a call and it will be automated. Now the question is, why do they need this? Well, they need this because they're not bringing in the revenue to the government to pay for all this debt, even with the interest rates at 0%. They tried FATCA, they tried Obamacare, and they tried everything else to bring in more revenue. It has not worked. The people are tapped out. And the reason why people are not paying their taxes or their student loans is because they can't find the jobs, and they don't have the money. I mean, there are certain areas of the tax code where people fall in between things, where if you're making enough money to survive, but not enough money to take the taxes out to live and support your family. And these people end up where they have a tax burden at the end of the year, because they're right on that borderline, and this affects a lot of people. But they want their money because they realize as this system continually declines, the revenue is getting harder and harder to find, which doesn't make sense because you would think with all the jobs, and especially the unemployment rate at close to 5%, you would think that everyone's working and everyone's paying their taxes. But as we see, these aren't real full-time jobs. The unemployment number is not really around 5%. It's closer to 30%. They're not counting those people who are not working. And those people who are working, they're just barely scraping by. And those kids that are coming out of college, they can't find jobs to pay for their student loans. So it looks like right now Ukraine is working with the IMF, and the IMF is going to change how they do business. They're going to change their lending rules. Why? Well, we understand in December, Ukraine owes Russia $3 billion. And under the IMF, what it means is, under their policy, they forbid loaning to any country that defaults on other governments. So Ukraine looks like they're getting ready to default on Russia. They're not going to pay their $3 billion. And the IMF is working with Ukraine, and they're going to change their policy where they can still loan the money even if they default on another government. How convenient. Hey, they didn't do that for Greece, did they? No, they did not. Now, China and Germany, they are setting up a Yuan-denominated exchange. Germany's Deutsche Börse has joined forces with Shanghai Stock Exchange and the China Financial Futures Exchange to trade yuan-denominated products. The project is going to start in November, and they're calling it, I think it's called Sinex. They will offer Chinese investment products to international investors. The new platform will become the first that's authorized to trade the yuan outside of the mainland China. So we can see this is putting more pressure on the dollar right now. And what we're seeing is that this entire system is being shifted and moved away from the dollar because this system is collapsing. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.